A few weeks ago, I found myself sitting across from a guy at a high-end coffee shop, and he was absolutely convinced he had finally outsmarted the universe. He was a quantitative analyst, the kind of person who sees the world in spreadsheets and probability curves. As he leaned over his laptop, his eyes were just gleaming with that specific, dangerous kind of confidence you only see during a bull market. He was showing me his latest foolproof strategy for a new series of speculative assets. His finger was tapping the screen with this rhythmic, giddy intensity. It's all just math, he told me, with this smug smile tugging at his lips. Once you understand the variables in the human psychology behind the trend, you simply cannot lose. The system is finally transparent enough for people like us. He really felt he was part of this new era of enlightened investing, where technology had finally stripped away all the risks of the past. But as I watched him, I couldn't help but think of another man, perhaps the greatest rationalist to ever live, a man who literally invented the calculus and the laws of motion we use to understand our world, Sir Isaac Newton. 3 centuries ago, Newton sat in a similar position of, intellectual dominance. He wasn't a gambler. He was a man of cold, hard logic. Yet he walked straight into a financial trap so devastating it didn't just drain his bank account. It shattered his belief in human reason. He famously remarked, "I can calculate the motions of heavenly bodies, but not the madness of men." The event that broke the world's smartest man was the South Sea Bubble. On the surface, it looked like a golden ticket, a government-backed monopoly on the exotic riches of South America. It had the prestige of the king, the blessing of parliament, and the frantic support of every elite mind in London. But beneath the ironclad logic of the trade was a predatory blueprint, one designed to turn national debt into a massive manufactured illusion. And what's truly unsettling isn't just that the smartest man in history lost millions. It's the fact that the exact same machinery of collusion, the way money and power manufacture sure things to lure in the brilliant and the brave alike, is still running today. The costumes have changed, but the trap is identical. And if you think your intelligence is a shield against it, well, you've already taken the first step toward the edge.
That narrative, that provides the perfect foundation for our deep dive today. We are analyzing the 1720 South Sea Bubble, not simply as a tale of historical greed, but as a meticulously documented predatory blueprint. Our mission is to really dissect the mechanics of that financial trap and to demonstrate that its structure, the way power and finance collude, is fundamentally identical to financial traps operating in our current system. We're looking at the foundational scheme, how massive national debt is engineered into speculative public assets, and why that transfer of risk is always preceded by a manufactured illusion of value.
Okay, so let's unpack this blueprint. It sounds like the South Sea Company wasn't born out of some, entrepreneurial zeal. It was born out of fiscal desperation. And it starts in a place that feels incredibly familiar today, a nation just drowning in debt.
That's the critical starting point. In the early 18th century, Britain was emerging from the War of Spanish Succession, and the cost of that conflict had just ballooned the national debt to, tens of millions of pounds. For context, this debt was consuming a staggering percentage of government revenue just in servicing costs.
Which would create a crisis of confidence, right?
Yeah.
Creditors holding that debt were getting anxious about repayment, and the government was completely strapped. So it wasn't just a financial liability, it was a political one that threatened the stability of the entire state.
Precisely. And that's why the South Sea Company, which was founded in 1711, wasn't created to sail ships and find treasure. Its fundamental purpose was, it was financial alchemy, finding a way to get this huge, cumbersome liability, the debt, off the government's books.
So it was a debt conversion vehicle, just dressed up in this dazzling costume of high finance and exotic trade. Let's focus on that illusion, because that's the part that gets sold to the public. The illusion of trade versus the actual financial reality.
Right. The official narrative they created was masterful. They sold the company as holding a glorious government-backed monopoly on trade with Spanish America. We're talking visions of gold, silver, spices, exotic riches that would flood London and enrich every single shareholder. The promise was basically perpetual growth, backed by the wealth of an entire continent.
That's the sizzle. But the reality underneath that sizzle was pretty grim, wasn't it? The trade monopoly was essentially worthless.
It was almost entirely illusory. Geopolitical realities meant Britain's access to Spanish America was minimal. It was strictly controlled by Spain. The trade was limited to, token cargoes and a small number of slave ships known as the asiento. The company's trading operations, they just never proved profitable, maybe a few symbolic voyages at best.
So it was all a front.
Exactly. The company became a financial enterprise completely by default, built on this facade of international commerce.
This is where the mechanics of that predatory blueprint really crystallize. We're talking about a complex, systemic debt for equity swap. Can you break down what an investor was actually holding before and after this swap?
Yes, this is the skeleton key to understanding the bubble. Before the swap, an investor held unsecured national debt. This was often in the form of low-interest, long-term government annuities. These were stable, sure, but they were illiquid and pretty unattractive. They essentially locked the investor into a fixed, slow repayment schedule over decades.
And the government just needed to make this burden disappear.
And the South Sea Company offered them a way out. The SSC convinced these creditors to swap that cumbersome illiquid debt for highly speculative, marketable SSC equity shares. Investors were promised guaranteed dividends on these new shares. And this is the key part. Those dividends were backed by government payments that were derived from the interest savings the government made by getting the debt off their books.
So wait, the government transfers its liability to the SSC's balance sheet. And the SSC then uses the interest payments that the government would have paid as collateral for their own dividend promise.
Exactly. They turned a slow, risky repayment obligation into a highly tradable, potentially parabolic asset.
That's financial artistry. It's a mechanism of collusion between government and private finance to transfer state risk onto the public through a speculative vehicle. And it creates the liquidity that fuels the entire mania.
It's the origin point of the illusion.
Yeah.
But a clever repackaging doesn't create a bubble on its own. You have to aggressively manipulate the market. And this is where we get to the rogue's guide to running this bubble. The 4 factors of market manipulation, which are, startlingly consistent across centuries.
Okay, let's start with factor 1. Insider trading. This seems to be the foundational technique that the SSC directors had already mastered before the bubble even inflated.
Absolutely. The playbook was actually tested and refined by a place called the Sword Blade Bank. Before the SSC's main scheme, Sword Blade successfully executed a swap where they exchanged unsecured government debt for their own bank shares. But here's the inside track. The bank's insiders secretly amassed huge holdings of that cheap, discounted government debt before the exchange was public knowledge.
So they were front-running their own deal.
Textbook front-running. They knew the price would soar once the official conversion was announced. It was all based on privileged information.
And the connection to the South Sea Company is direct. It's not just a similar scheme, is it?
No, it's direct. 5 of the eventual SSC directors came straight from the Sword Blade Bank. They literally incorporated this predatory insider playbook into the SSC scheme from day one. It guaranteed that the people initiating the massive debt swap were also the ones positioned to profit first and fastest.
So once you have the scheme, you need official protection. Factor 2, bribes and official endorsement. They needed the government's stamp of approval to remove any public doubt.
And they got it. The SSC won the right to buy the remaining national debt, not through, superior financial planning, but through massive, undeniable bribes distributed across the political spectrum. Parliament members, cabinet ministers, associates of the king, they all received shares or insider deals, often for minimal or even zero cost. But the ultimate endorsement came when the king himself became the official governor of the company.
Wow. The moment the king is the governor, who in London dares question the underlying value, the psychological hurdle for public trust is it's instantly eliminated. The risk isn't just reduced, it's seemingly removed by the highest authority in the land.
That legitimacy turned the hype into certainty. And once they had that momentum and that insider support, they moved ruthlessly to secure their monopoly. Which brings us to factor 3, the Bubble Act.
This is the fascinating legislative collusion. The government passed this act that banned rival ventures from seeking investor capital without a royal charter. On the surface, it looked like a clean regulatory move to protect investors from what they called nauseous projects.
But the irony is almost unbelievable. The sources are crystal clear. The SSC explicitly requested this regulation.
Why? Why would they do that?
Well, while the SSC was selling trade with Spanish America, London was just flooded with hundreds of competitive schemes, some legitimate, some absurd. Companies selling everything from perpetual motion wheels to extracting silver from lead. There was even a company for carrying on an undertaking of great advantage, but nobody to know what it is.
So the Bubble Act wasn't about protecting the public from risky assets at all.
Not really. It was about protecting the SSC's monopoly on the speculative capital that was flooding into London.
It crushed all competition.
Exactly. It made sure that all the feverish speculative investor money flooding the city had only one sanctioned place to go: South Sea Company shares. The legislative intervention guaranteed their monopoly on investor cash flow.
Which brings us directly to the engine room of the mania, factor 4, the Ponzi mechanism. You can only sustain a stock price at 9 times its starting value if you have an endless stream of new believers.
The parabolic price increase was fueled entirely by mass speculation, completely divorced from any real economic fundamentals. The company promised guaranteed dividends to the debt holders, but those dividends weren't paid by trade profits because, well, they didn't exist. They were paid by the cash proceeds flowing in from new investors participating in the for-money subscriptions.
Tell us more about those subscriptions. That's where the Ponzi mechanism is clearest, right?
That's right. The company sold new stock in successive waves, or subscriptions, throughout the spring and summer of 1720. And every new wave of cash injection was used to pay the dividends and maintain the illusion of profitability for the earlier participants. This was explicitly recognized by contemporary observers as a scheme where early investors benefited directly at the expense of later ones.
It sounds like a pure feedback loop. Collusion creates the structure, bribes legitimize it, the law kills the competition, and the Ponzi cash flow generates the explosive, gravity-defying returns that attract the final fatal wave of retail investors.
And this rapid manufactured inflation brought us to the peak, the mania and the leverage trap. Shares soared from around £100 at the start of 1720 to nearly £1,000 by summer. But what made this accessible to the general public was the ability to buy on credit.
The democratization of the bubble through easy credit, that always seems to be the accelerant in these crises.
Always. With absurdly low down payments. The third money subscription, for example, required as little as 10% down, so you could buy 10 times the stock with the same amount of cash, with installment payments stretched out over years. This just injected massive leverage into the market, pulling in the middle class and inflating the stock price far beyond what would have been possible with sober cash investment.
It created that fatal collective hallucination. Everyone was operating purely on emotion, on herd behavior, playing the greater fool game because the returns were so immediate and seemingly guaranteed by the crown. But the moment you rely on leverage in a speculative market, you've introduced a fragility into the system that will break you the second the momentum shifts.
And that fragility broke the most leveraged and, ironically, the most rational among them. And that brings us right back to Sir Isaac Newton. If this engineered madness can trap a genius who literally defined rationality, it fundamentally questions the protective power of high intellect in a manic market.
Let's transition there. If pure brilliance failed in the face of mass hysteria, where does that leave the investor who relies on the absolute logic of their models? That brings us to the core tension between perfect reason and a deeply manipulated reality.
Newton's experience is not just a cautionary tale. It's a deep study of cognitive failure in the face of euphoria. And it's crucial to establish that he wasn't reckless. Before 1720, he was a careful and shrewd investor, holding conservative, successful positions in reliable government or quasi-government securities like Bank of England stock. He understood value.
And he was involved in South Sea Company's securities early on, right? When they were still relatively solid and maybe even undervalued. So he knew the asset.
Absolutely. He was one of the earliest to invest, dating back to before the frenzy. So when 1720 hit, he was initially operating from a position of experience and, rational assessment. This leads us to his initial victory and, critically, his fatal re-entry.
So tell us the timeline of that disastrous reversal.
Newton initially tasted the market euphoria and acted prudently. He appears to have liquidated a large fraction of his SSC holdings sometime in April or May of 1720. It was a perfect move. He recognized the parabolic ascent was unjustified, took his money off the table, and secured a profit that likely exceeded £20,000.
He won the game. He successfully timed the market and secured an immense fortune. He executed the perfect rational exit. So, why on earth did the greatest mathematical mind of his age get back in?
The simple answer is envy and FOMO, the raw emotional power of the madness of men. As the price continued its vertical climb, soaring past his sell point, he panicked. He wasn't panicking about losing money. He was panicking about missing out on the increasing wealth of his peers.
Oh, that's brutal.
He dove back in around mid-June 1720, putting all that money, his initial winnings, his realize and gain back into South Sea securities at approximately double the price he received just weeks earlier.
He didn't just reverse his position. He committed to a level of irrationality that contradicts his life's work. He bought less than half the stock for the same money he had previously secured as profit.
And the catastrophe didn't stop there. He then shifted almost all of his other diversified conservative holdings, his government annuities, his Bank of England stock all, into SSC stock at the very apex of the mania. By 1721, when the bubble had burst, almost every pound he had was concentrated in the massively depreciated South Sea stock.
This just demonstrates that intellectual brilliance isn't a prophylactic against psychological pressure. His high capacity fostered the arrogance that he could outsmart the collective madness, not once, but repeatedly.
That's the high IQ trap. He saw the numbers, he understood the geometry, and yet the sheer intoxicating velocity of the mania convinced him that the rules of gravity had been suspended, at least for a little while longer. The arrogance was believing he could time the emotional peak of the herd better than the herd itself.
So let's quantify the sheer scale of this personal disaster. How much did he actually lose?
If we look at the conservative estimates, his final quantifiable loss exceeded 11 to 13,000 pounds compared to simply holding his diversified assets. But the psychological and practical loss, accounting for that sell high, buy double maneuver, easily exceeded 20,000 pounds.
And 20,000 pounds in 1720 is an almost unimaginable sum. It represents millions in modern purchasing power.
It was life-changing wealth. Lost not because of ignorance, but because of a total failure of emotional discipline in the face of what he knew to be irrational.
It's incredible.
It fundamentally shattered his faith in the ability of reason to prevail against collective delusion. His protege, a young mathematician named Elias, made the exact same mistake. He was relying on his superior quantitative models to predict the precise moment to exit, a second before the collapse. They both believed their intellectual edge gave them immunity.
But the reality is that high intellectual capacity, when it's detached from foundational value, can actually become a liability. It feeds the hubris that you are above the consequences of the market's psychological tsunami.
That's the deepest takeaway. He died rich, but that was largely because of his steady income as master of the mint. His loss remains the quintessential example of a genius succumbing to reigning groupthink. He survived, but only barely and at immense cost.
The intelligence shield failed. And this leads us to a fascinating modern problem that connects directly to that quantitative analyst I met in the coffee shop. If pure brilliance and quantitative analysis fail against market mania, what role should objective theoretical frameworks play in a world that is so clearly manipulated by central banks and state power?
This is a critical distinction that many investors, especially those who come from purely academic or mathematical backgrounds, they fail to grasp this. Economic theory, whether you adhere to the Austrian school, Keynesian, or Chicago school, is descriptive. It is not an investment philosophy. It's a domain of facts designed to provide a template for understanding social interaction and anticipating outcomes.
Right. So the Austrian school, for example, it provides a robust, highly accurate theoretical framework for understanding free markets and diagnosing market distortions like malinvestment from artificially low interest rates.
The theory is undeniably elegant. It's often correct in its diagnosis of systemic instability. But the fundamental difficulty arises when you try to apply a rigid theoretical model to a non-free economy, which, by definition, is where we live today. Our markets are constantly impacted by massive monetary and fiscal interventions. Applying a pure model, say, rigidly betting on a deflationary crash when the central bank is actively printing trillions, can be, irrational in the pursuit of making money.
You're right on paper, but broke in reality. And this brings up the core conflict that has broken so many theory-driven investors. The problem of duration and rationality. How long can you be right, but early?
This is the essential tension. If you look at the last century, Austrian economists have consistently and continually predicted long-term inflation, even currency collapse, because of central bank policies and abandoning sound money principles. And over that 100-year span since the creation of the Federal Reserve, that prediction is undeniably true. The value of the dollar has been systematically debased.
But if an investor had rigidly bet their entire portfolio on that inevitable long-term inflation prediction, say 10 or 15 years ago, they would have likely gone bust or missed out on massive growth in other sectors.
That's the brutal reality. As the famous line goes, markets can stay irrational longer than any investor can stay solvent. Eventually, prices converge to value, but the opportunity costs, the margin calls, the carrying costs of waiting for the market to prove your theory correct can destroy your wealth first.
So being early, especially when you're facing an omnipotent central bank, is indistinguishable from being wrong.
That's right. The theoretical certainty provides little protection when the psychological wave is a global tsunami.
So if relying solely on one rigid theoretical framework is the enemy of successful investing in a manipulated, distorted environment, how do successful survivalists navigate this landscape?
Well, they blend theories, and crucially, they accept the reality of the distortion. This is often summarized as Austrian investing in a distorted world. It's a philosophy that recognizes that distortions like quantitative easing and fiat currency expansion exist. They're the dominant reality. So instead of rigidly betting on the timing of the distortion's collapse, they attempt to hedge against the systemic risk while operating within the rules of the current system.
Let's clarify what that practically means, especially when we consider that the fundamental fraud in 1720 was a fiat illusion, a paper promise backed by worthless trade.
It mandates what you might call the hard asset anchor. This is the core principle. In times of irrational exuberance and widespread fiat illusions, the only defense is to transition wealth into tangible hard assets. We're talking about productive land, physical gold, and increasingly digitally scarce assets like Bitcoin.
And why do those specific assets act as anchors when everything else is collapsing or being debased?
Because they possess foundational scarcity and tangibility, which state-backed fiat currency just lacks. The state can always print more money, more fiat, or manufacture speculative assets like SSC shares or mortgage-backed securities, and that dilutes the value of every existing unit. Hard assets, by their nature, cannot be easily printed or manufactured by the state's financial machinery.
So in 1720, the farmer with the productive land and the solid gold coinage survived the bubble intact, while his high IQ neighbor, Sir Isaac Newton, holding worthless South Sea paper, was ruined. The tangible remained when the speculative illusion vanished.
That tangible anchor is the key defense against currency debasement, the ultimate long-term consequence of the state's financialization of debt, which is exactly the engine that drove the South Sea bubble. The SSE was a massive debt-for-equity swap that created immense, unfounded financial paper wealth and that inherently erodes confidence in the existing currency system.
And this brings us directly into the modern financial era. We aren't really talking history anymore. We are discussing the structure of today's market. That debt-for-equity swap, that transfer of government liabilities into speculative public assets, is the core link to our current environment. Let's look at how the South Sea blueprint has been used repeatedly, leading us right up to Ray Dalio's framework for the long-term debt cycle.
The SSE scheme is a timeless collusion machinery for the elite. Its sole function was to transfer the risk and volume of national debt to the public through speculative assets. And this exact pattern has repeated across centuries, demonstrating that the structural weaknesses of human nature and political governance remain unchanged.
We saw the same underlying mechanism in the dot-com bubble, right? Where promises of perpetual, non-existent future growth were packaged as guaranteed wealth.
And even more structurally similar, the 2008 housing bubble. The key mechanism there was the repackaging of inherently risky subprime mortgages, a form of bad debt, into highly rated mortgage-backed securities, or MBS. These securities were sold as rock-solid investments, blessed by ratings agencies who served the same function that Parliament and the King served in 1720.
It's the same template, conferring official, unearned legitimacy onto inherently fragile, debt-backed assets to encourage mass public investment.
And the outcome is always identical, regardless of the era or the asset class. First, a speculative mania built on illusions. Second, a collapse where the politically connected and elite players were bailed out or survived with deep pockets. And third, the costs are socialized downward, and the ordinary retail investors, the latecomers, take the crushing blow. The wealth flows upward and concentrates.
This structural inequality and systemic bailout mechanism connects 1720 directly to Ray Dalio's analysis of the long-term debt cycle.
Dalio argues that modern systems rely entirely on the expansion of a global reserve currency, whose value is determined not by intrinsic backing, but by state confidence and the ability to expand credit. This cycle of debt and credit expansion continues, escalating in scale with each passing decade until a specific endgame is reached.
Okay, so how does Dalio define the endgame of that long-term debt cycle? What happens when the system runs out of road?
He defines it as the point when the central bank loses its ability to produce money and credit growth that successfully passes through the economic system to produce real economic growth. When the massive stimulus no longer translates into tangible economic output, the system approaches a reckoning.
And are we seeing contemporary symptoms that mirror the late stages of that cycle, akin to the overheating just before 1720?
Absolutely. The current symptom is that central bank policies, such as quantitative easing or QE, are designed to pump liquidity into the system. But the growth is disproportionate. We see asset prices, financial assets, equities, real estate rise exponentially, but the real economy, measured by wages, tangible capital investment, productivity, it's not truly stimulated or growing proportionately.
Let's look at the mechanism of QE, because it really does function as a modern debt-for-equity transfer.
Right. When a central bank engages in QE, it is essentially printing money electronically to buy financial assets, often government bonds or other securities, from commercial banks and large institutions. So the central bank is taking illiquid or long-term government liabilities and replacing them with liquid reserves held by these institutions.
And those institutions, flooded with new liquid capital, they don't typically invest that cash into building factories or hiring workers.
No, they bid up financial assets. QE primarily benefits the wealthy because they hold significantly more financial assets than the poor or the middle class. So QE pushes up asset prices, which artificially widens the wealth gap. This is the modern, sanitized version of the 1720 debt-for-equity transfer.
Using state power and monetary policy to financialize debt, which fundamentally transfers wealth upward, fueling asset bubbles, and ultimately eroding long-term confidence in the currency.
And it's a crucial insight that the government itself gained very little net profit from the 1720 operation. It was mostly a massive redistribution within the company, from the latecomers to the insiders.
That detail is often overlooked in the grand story, isn't it?
It is. While Parliament eventually stepped in and confiscated some director estates, the ultimate goal of the intervention was structural preservation. It wasn't about achieving fairness for the losers. It was about ensuring the financial machine survived and that parliamentary faith in the general system, despite the massive fraud, was eventually restored.
So, when the dust settled and the system was restructured, who were the definitive winners and losers of the South Sea bubble?
Well, the system explicitly favored the old proprietors, the early entrants and insiders who capitalized on the initial debt-for-equity swaps and the Ponzi structure. Even after all the subsequent adjustments, fines, and forfeited pledges were accounted for, the insiders managed to secure immense net gains, calculated at around 59% profit. The restructuring essentially allowed them to keep their initial vast leveraged gains while shifting the final losses onto the latecomers.
Meaning the system was engineered not to destroy the wealth created by the illusion, but simply to transfer the final liability onto the least connected and most recent believers.
Exactly. The losers were the later debt subscribers and money subscribers, the ones who came in when the mania was peaking. Despite Parliament's attempts to equalize losses, the latecomers took the crushing blow. Long annuitants lost between 17 and 25% of their principal, and the short annuitants lost even more, between 24 and 40%. The unequal treatment was a feature, not a bug, of the ultimate bailout. It ensured that the connected players who structured the debt-for-equity transfer survived and profited handsomely at the expense of the enthusiastic crowd.
It is the same story again and again, regardless of the asset class or the century. The smart money and the connected players survive and profit, while the enthusiastic, highly leveraged crowd is left with the loss. That is the true blueprint.
And it demonstrates that the ultimate defense against this engineered instability is not intellectual brilliance, as Newton proved, but financial sobriety and, crucially, a profound skepticism toward any asset that promises exorbitant returns based on nothing but official blessing and mass enthusiasm. This deep dive into the 1720 South Sea bubble reveals that it is not a footnote in history, it is a profound mirror reflecting the core drivers of modern financial crises. Greed, FOMO, and the systemic failure to question official narratives about guaranteed wealth. The genius of the SSC was turning government risk into speculative public belief, and that exact mechanism is the key structural failure we must recognize in modern financialization. And we've seen that the current system, through mechanisms like QE and expanded government debt, is functionally mirroring the debt-for-equity transfer of 1720, creating massive asset inflation disconnected from real economic growth. This is the structural signpost that history provides, pointing toward the long-term debt cycle endgame. The mandate of survival is clear. Real wealth is not built on hype or believing that this time will be different. It is built on understanding the true structure of the game, avoiding the illusions engineered by power, and preparing for the inevitable reckoning. Sobriety, caution, and a tangible anchor, whether it is productive land, gold, or a scarce digital asset, are the only reliable defenses against the madness of men. That is the lesson Isaac Newton paid millions to learn. And that is the knowledge you now possess.